Okay, folks, we've got substantial developments happening today concerning the ongoing tariff situation that you need to know about. A flurry of events has transpired, some breaking just this morning, others rumored. We're seeing the European Union make a significant offer to the United States regarding industrial goods tariffs. Simultaneously, the Federal Reserve is scheduled for a closed-door meeting today, sparking whispers of a potential emergency interest rate adjustment. Adding to the mix, Donald Trump has been active, issuing statements that really highlight the critical nature of interest rate reductions. We believe these elements are interconnected, particularly the tariff movements, which seem tied to broader economic strategies, including the push for lower interest rates and the ongoing effort to reshape manufacturing landscapes, especially concerning China. We'll delve into the specifics, look at the odds of a Fed rate cut, and analyze Trump's recent commentary later in this video. Remember, we'll have detailed conclusions at the end, so stay tuned. A lot is unfolding in the world right now, and we're here to break it down for you. Before we dive deeper, if you find this analysis valuable, please consider hitting that like button and subscribing to our channel. Your support is crucial for us to continue bringing you these updates. Also, drop a comment below letting us know where you're watching from. We love hearing from our audience. The European Union has signaled its readiness to deliberate on a zero-for-zero tariff framework with the United States concerning industrial goods. This development is particularly noteworthy because it represents a swift pivot from the EU's stance just yesterday. For a while, rumors suggested that the EU was prepared to immediately counter any new U.S. tariffs, potentially around 25% or similar, with reciprocal measures, much like the Canadians implemented previously. However, within approximately 12 hours of those expectations solidifying, the EU publicly stated its willingness to discuss eliminating these reciprocal tariffs altogether. This shift is quite significant. It's not just the EU. Several other nations, including Vietnam, Israel, and India, have expressed similar sentiments, indicating a broader global interest in de-escalating trade tensions through negotiation. China, understandably, would also likely welcome talks with the U.S., though given the complexities in Trump's stance, significant tariffs on Chinese goods are expected to remain regardless of any specific negotiation outcomes, perhaps barring a major concession related to something like TikTok. The EU's quick turnaround is fascinating. Unlike China, the EU doesn't possess that extreme trade surplus with the U.S., although a surplus does exist, which was Trump's original justification for imposing the tariffs. The EU typically employs different mechanisms, such as value-added taxes, or VATs, on imported goods. This involves a tax paid by the European company purchasing the product, functioning similarly to a tariff but structured differently. They also utilize extensive regulations that can make U.S. products, particularly agricultural goods, less competitive in European markets. Therefore, the EU might be quite content to reduce formal tariffs to zero, knowing they have these other tools and regulations in play. This suggests that any real negotiation would need to encompass more than just tariff rates. It would have to address VAT application, regulatory barriers, and potentially currency manipulation tactics. Many Trump supporters are hailing this zero-for-zero offer as a major victory, but the reality is more nuanced. The EU wouldn't likely be negotiating a true zero-tariff situation on U.S. goods without considering these other factors. It points towards a complex web of trade strategies where formal tariffs are just one component. The EU's rapid shift from threatening retaliation to offering talks underscores the high stakes and the potential effectiveness of the pressure being applied. Please make sure to watch this video until the very end, as we'll be summarizing key takeaways and offering our conclusions on what this all means. Now let's turn our attention to the Federal Reserve. Today, they're conducting a closed-door board meeting. This has inevitably fueled speculation about a potential emergency rate cut. While rumors have circulated, it's essential to look at the actual probabilities. Based on market indicators and analyses we've seen, the odds of an emergency cut emerging from this specific meeting appear quite low. However, the idea of rate cuts is central to the current economic discourse, heavily amplified by recent statements from Donald Trump. He's been increasingly vocal, putting out messages that strongly emphasize the importance and necessity of the Fed lowering interest rates. We believe this pressure campaign is a significant factor behind the scenes. The timing of these tariff announcements and negotiations might not be coincidental. It's plausible that these actions are part of a larger, aggressive strategy orchestrated to compel the Federal Reserve to reduce interest rates sooner rather than later. Trump clearly desires lower rates, likely to stimulate the economy, perhaps counteract any negative impacts from the tariffs themselves, and bolster economic performance, which is always politically advantageous. The Fed, historically protective of its independence, finds itself in a delicate position. They aim to manage inflation and employment without appearing swayed by political pressure. Yet the economic landscape is undeniably being shaped by these trade policy decisions and the uncertainty they create. This closed-door meeting, therefore, takes place under considerable scrutiny and against a backdrop of heightened economic and political tension. Whether any immediate action is taken or not, the focus on interest rates and the Fed's potential response remains a critical element in understanding the broader economic picture and the motivations driving current trade policies. The emphasis Trump places on rate cuts suggests it's a primary objective, possibly viewing the tariffs as leverage to achieve that goal. Donald Trump's recent communications, particularly his posts on social media, leave little doubt about his focus. He is intensely advocating for interest rate cuts. He links lower oil prices and food prices to a state of no inflation, directly urging the slow-moving Fed to act on rates. This narrative directly pressures the Federal Reserve, framing their current stance as overly cautious or sluggish. It positions Trump as the champion of economic stimulus through lower borrowing costs. We interpret these actions, including the broad application of tariffs, not just as isolated trade measures, but potentially as interconnected parts of an aggressive strategy. The goal appears to be creating conditions, whether through economic pressure, market uncertainty, or direct calls to action, that force the Fed's hand, pushing them towards rate reductions much earlier than they might otherwise consider, especially looking ahead to a potential second term for Trump. He seems determined to have lower rates established early on. While many analysts and media outlets predict that tariffs will inevitably lead to higher inflation due to increased costs of imported goods, Trump's messaging and actions suggest a different calculus. It's possible he believes the economic uncertainty and potential slowdown caused by the tariffs will actually dampen inflationary pressures, or, at the very least, provide the justification needed for the Fed to cut rates despite any cost-push effects from the tariffs themselves. He's essentially trying to steer the economic narrative and influence monetary policy simultaneously. His tweets also serve to rally his base and shape public perception, portraying the Fed as an obstacle to economic prosperity that he is actively working to overcome. This public pressure campaign, combined with the tangible effects of trade policy, creates a complex dynamic for the central bank. Let's examine the inflation situation more closely, as it's the key justification the Fed uses for its interest rate decisions. Donald Trump asserts there is no inflation, pointing to falling oil and food prices. Indeed, some alternative measures like Truflation recently indicated inflation was down to around 1.1%, reportedly a 4.5-year low. If these lower inflation trends are confirmed by official data, like the upcoming figures expected around April 10th, it significantly strengthens the case for the Fed to cut rates. However, there's ongoing debate and even accusations of misrepresentation regarding official inflation numbers, a trend observed since Trump took office. While the official narrative often lags, the underlying data, according to sources like Truflation, suggests inflation has been decreasing. The critical point here is the linkage. Lower inflation provides the necessary cover for the Fed to implement the rate cuts Trump is demanding. The conventional economic view is that tariffs increase costs and thus fuel inflation. However, an alternative perspective, perhaps the one underpinning Trump's strategy, is that the uncertainty and potential economic slowdown induced by aggressive tariff policies could actually counteract inflationary pressures by reducing overall demand. It's a high-stakes gamble. Use trade disruption to force the Fed's hand on rates, betting that the inflation metrics will align, or can be presented as aligning, with the need for cuts. The Fed needs justification, and falling inflation whether measured officially or through alternative metrics Trump chooses to highlight, provides that justification. This entire interplay, tariffs, inflation data, Fed policy, and political pressure, is geared towards achieving that primary goal of lower interest rates. Revisiting the global landscape, the EU's offer is just one piece. As mentioned, countries like Vietnam, Israel, and India are also reportedly interested in negotiating zero-for-zero tariff deals. This indicates a widespread desire among U.S. trading partners to avoid escalating trade conflicts and find mutually agreeable terms. However, these negotiations are rarely straightforward. Beyond simple tariff rates, discussions invariably involve complex issues like value-added taxes, VATs, differing regulatory standards, especially concerning food and safety, and accusations of currency manipulation. The EU, for instance, relies heavily on VATs and stringent regulations, which act as non-tariff barriers. A zero-for-zero tariff deal with the EU wouldn't necessarily mean completely free trade if these other barriers remain untouched. This complexity was perhaps highlighted by a recent rumor, subsequently denied by the White House, suggesting Trump was considering a 90-day pause on all tariffs, except those targeting China. While officially labeled false, the emergence of such a rumor underscores the fluidity of the situation and the potential for various negotiation tactics. It could have been floated to gauge reactions or signal flexibility. The denial preserves Trump's leverage. The exception for China in that rumor is telling. Due to the massive trade deficit and broader geopolitical competition, tariffs on China are treated differently. Trump appears committed to maintaining strong pressure on Beijing, potentially using tariff relief as leverage for other concessions, perhaps even related to the ongoing saga over TikTok's ownership, as some have speculated. He has explicitly linked the two in recent statements. So, while multiple countries may seek tariff reductions, the path and outcome of negotiations will vary significantly, especially when comparing allies like the EU to strategic rivals like China. Each negotiation involves a unique set of underlying issues beyond the headline tariff rates. Looking at the broader economic picture and market sentiment, there's undeniable nervousness. The potential for escalating trade wars and uncertainty surrounding Federal Reserve policy has contributed to recent market downturns. This feeds into concerns about a possible recession. Market prediction platforms like Polymarket show fluctuating but significant odds assigned to a U.S. recession occurring in 2025. At times recently, the odds were above 60%, though they've dipped slightly to the high 50s. Of course, these markets reflect speculation and fear as much as fundamental analysis. A technical recession is typically defined as 2 consecutive quarters of negative GDP growth. We still await the official GDP numbers for the first quarter of this year. If Q1 shows positive growth, as some anticipate, it pushes the possibility of a technical recession further out. However, if Q1 were to come in negative, the focus would immediately shift to Q2, raising the stakes considerably. The tariffs themselves are a major variable here. Critics argue they could directly trigger a recession by increasing costs, disrupting supply chains, and dampening business investment due to uncertainty. Supporters, or perhaps Trump's own strategic view, might see them as a necessary, albeit potentially painful tool to achieve broader goals like lower interest rates and revive domestic manufacturing, possibly believing the long-term benefits outweigh the short-term risks, including a potential slowdown or mild recession. The market's reaction reflects this uncertainty. The significant drop in recession odds coinciding with the EU's offer suggests traders see negotiation and de-escalation as reducing economic risk. However, the odds remain elevated, indicating that the underlying concerns about trade policy and its impact on growth persist. The path forward depends heavily on Q1 GDP results and the progress, or lack thereof, in trade negotiations. Ultimately, analyzing all these developments, the EU's tariff offer, the Fed's closed meeting, Trump's persistent calls for rate cuts, the mixed inflation signals, and the fluctuating recession odds, points towards a central theme. It appears Trump is employing a multifaceted and aggressive strategy, primarily aimed at influencing the Federal Reserve to lower interest rates significantly and rapidly, ideally early in a potential second term. The widespread tariffs, while potentially serving secondary goals like encouraging domestic production and addressing trade deficits, especially with China, seem strategically designed to create economic conditions and political pressure that make rate cuts seem necessary or unavoidable for the Fed. Trump has repeatedly voiced his frustration with the Fed's pace and clearly wants monetary policy to be more accommodative. The low inflation readings, whether official or alternative, provide the crucial justification for such cuts. The negotiations with trading partners like the EU, offering potential de-escalation through zero-for-zero tariffs, can be presented as policy successes, while simultaneously alleviating some of the potential inflationary pressure or market fear generated by the tariffs themselves. However, the core objective seems to be maneuvering the Fed. This involves balancing the push for domestic manufacturing, which might raise costs initially, with the need for low inflation to justify rate cuts. It's a complex balancing act with inherent risks, including potentially triggering a slowdown or even a recession if miscalculated, or if global partners don't cooperate as anticipated. The situation with China remains distinct, with tariffs likely serving a more long-term strategic purpose related to competition and the substantial trade imbalance. Predicting Trump's next specific move remains challenging, as he uses tariffs flexibly as both a tool and a threat. But the overarching goal of securing lower interest rates seems to be the driving force behind much of this economic maneuvering. Whether this strategy will ultimately succeed in boosting the economy without causing undue disruption remains the critical question.